Okay, so um, notes payable, it's telling us that there's only one transaction during the period. Okay, having only one long-term notes payable transaction. That's what it says. So if we just simply look at our comparative balance sheet here, we can see that the notes payable went down. Okay, so we have the beginning balance, which is the 66,000, and then the ending balance, which is 59,000. So we basically have, again, 66,000, 59,000. This is our ending balance. This is our beginning balance. So then how do we get from beginning to end? What do we need to do? Well, we must have had a credit, right? 7,000. So what is this? When we credit notes payable, what does that represent in like in just kind of like actual business terms? What happened here? Yeah, you paid off some of your notes payable. So this is a what is the so this is the debit. What is the credit? What would have the credit been in the journal entry? Yeah, so cash, right? So this represents a cash outflow. Okay, so this is a payment of notes payable. Okay, so uh, uh, you just need to understand kind of what the second part of this is, right? And it's important because that's, it's part of the statement of cash flow. So a payment of notes payable is related to a cash outflow because it's a debit to notes payable, credit cash. Okay. So it's the same thing with this issuance of common stock. There's only also one common stock transaction. It's not like we were issuing stock and then buying some back. We just simply had one common stock transaction. So all you have to do is look at what happened to common stock. So you can see that our common stock no par value went up. It went from 34,000 to 47,000. So 34,000 to 47,000. So this is beginning, this is ending. So what do we do? How do we get there? Do we have to debit or credit the common stock? Sure. What if I put 5,000 here? What would have been my ending balance then? Exactly. Okay, so then you want to change your answer, Scott? Okay, good. Okay, so we must have had a credit, and this is from buying back or issuing common stock. What is it when we credit common stock? What are we going to debit? Cash. Okay, so this is issuance of common stock. Again, this is like the first journal entry we ever learned. Issuance of common stock. And so this is going to represent a cash inflow, and it's going to be just like notes payable. It's a financing transaction. So this is all going to be in the section on financing cash flow. We're going to have an outflow of 7,000 from payment of notes payable, an inflow of 13,000 from issuance of common stock. Okay. And then finally, retained earnings. Okay, so we have retained earnings, ending balance 289,000, beginning 239,000. So let me just put this in here. 239, 289. Is that right? 239 and 289? 239 and 289. Okay. So is it just is there just some $50,000 something? What is this? We need a total credits $50,000. Is this dividends? Does that $50,000 represent dividends? What am I missing here? Yeah, Tyler. Okay, good. So first we need to add in net income. Okay, so where should I get that from? Income statement. So 110,000 is net income. Would that have been in retained earnings a debit or a credit of 110,000? I know Tyler knows. Someone else know? I know Muhammad knows. Someone else know? Scott, what do you think? It's gonna, so is the 110,000 increasing or decreasing retained earnings? Who has a confident response? Does net income increase or decrease retained earnings? Yeah, it increases. So is that a credit or a debit to retained earnings? Credit. Okay, good. So this is net income. Okay, so is that if we just had that, oops. Okay, so we need some kind of debit. Okay, because if we just had these two, we would be our balance would have been 349,000, but that's not right. Our ending balance we know is 289 because we have the balance sheet. Okay, so that means to figure this out again, we had this is in a quiz. There's some missing debit. Okay, so how do we figure that out? Well, we can just do this minus this, 60,000. So if we do this 60,000, now let's just verify this plus this minus this. Yes. Okay, so what is this debit? What is this? Where is it coming from? Yeah, dividends, exactly. Okay, that's that's why I gave you the hint. The statement of retained earnings. Starting balance plus net income minus dividends equals ending balance. So we had three of those pieces of information. We had starting balance, ending balance, and net income. And we just used those three to solve for that missing variable, which is dividends. Okay, so this is also going to go in the section on financing. Okay, because it's related to equity. Yeah, yeah, because goes back to chapter 4. So let's pretend we had a net loss. It's not gonna this it would be impossible for this to have gone up. But let's say it was 110,000. I don't know. Let's say this is 200,000. Is that gonna work? No, 100,000. 10,000. Let's just say that. Okay. um, then you would have this debit. This is from a net loss, and then to figure out what the dividend was, you basically have this plus this minus this, 139,000. And then just to verify, this minus this minus this. Oops. Yeah, so this should be 119. Okay. This minus this minus this. Okay. And so this would have been your dividend. So yeah, I mean, you basically have to use this skill of, well, first you have to use the background knowledge of where does net income or net loss go? Is that a debit or a credit to retained earnings? And then you have to use the skill of solving for some missing debit or credit. And the reason why I needed to change this number is because this could not have been 289,000 because both dividend and net loss are both debit. So it would have been impossible to increase retained earnings. That's why I had to kind of alter the numbers. Okay. So really, this is like this kind of nuts and bolts, like understanding T accounts, understanding debits and credits. And yes, we've like gone a long way and built up a lot of things, but really this information, this framework was presented in chapter 4 or something. Okay, so if hopefully you still remember this. This is actually the important thing, understanding what is retained earnings, what are the components of it. I'm trying to emphasize that even just remembering that is important. All the details of, whatever, all the extra minute calculations we've done is not as important as understanding what these things are, in my opinion. Okay, so hopefully you do. And it looks like a lot of you do. Okay, but if not, you'll have to just go back and review. Okay, okay. Let's start this 14-38B. Okay, this is now building on what we just did. Um, you have an income statement and another comparative balance sheet. And you also have some additional information here, okay? There's a investment that was made 100% with a long-term note payable. So this is going to kind of be a note, right? Because it's not going to appear on the statement of cash flow because there's no cash that's transacted, even though it was an investing and a financing activity. So you'll have to just kind of read through the financial statements, read through this additional information, and now you're going to do the full thing. Okay, you're going to start with the operating section, you're going to do the investing section, you're going to do the financing section, and you should be able to reconcile how cash went from 15,600 to 26,700. Okay, that's how you'll know that you did each of those three sections correctly, in that the net change in cash should reconcile this first line here. Okay, so um, again, for the operating section, you have the add backs. Okay, so again, I would go back to this slide where um, this is kind of giving you the outline. Okay, start with net income, add back depreciation, depletion, and amortization expense, add back or subtract any gains or losses from the disposal of any assets. And then you'll have to do these adjustments for how the current assets and current liabilities accounts changed. And that will give you your cash flow from operations. Okay, so this is a step-by-step guide. Start with net income, do these adjustments, and you'll get your cash from operations. So this is definitely the hardest section, the operating section. Okay, so but yeah, now it's time for you guys to be pushed out of the nest and see if you can figure it out. Okay, see if you can fly. So try to do it yourselves, and of course we'll do it together later. Okay, so again, we start with net income, and we are going to adjust net income because again, there's a mix of cash and non-cash things going on in net income. So net income is from this income statement 99,500. Okay. The first and obvious add back is depreciation expense. Depreciation. We know for a fact depreciation expense is fully non-cash because the journal entry is debit depreciation expense, credit accumulated depreciation. There's no cash involved with that. So this is a pure non-cash expense that we know reduced net income, but not because of a cash flow, because it's a accrual expense. It's a accrual based accounting expense. Okay, so now it didn't mention any gain or loss on the sale of an asset. Yeah, so it says a plant asset was disposed of for $0. During the year, there were no sales of land, no retirement stock, no treasury stock transactions. A plant asset was disposed of for $0. So there's no cost and accumulated depreciation of the disposed asset was okay. So there was a disposal, but the book value was what of that disposed asset? Zero. Okay, the cost and accumulated depreciation of the disposed asset was $12,060. So though we got $0 for it, it was already on our balance sheet for zero. So there was no gain or loss. Okay, is everyone good with that? So we don't have to do that adjustment because is neither a gain nor a loss. It's like break even. We had we had it on our balance sheet for 0, and we got rid of it for 0. Okay. So now we'll turn to the changes in our current assets and current liabilities. Okay, so we can see here accounts receivable went up from 25,300 to 26,500. So that's an increase of $1,200. So this is increase in accounts receivable. Now, is that going to be an increase or decrease in um, cash flow? Yeah, Tyler. It's a decrease, right? So basically, let's just make sure we understand this. So we had accounts receivable 26,500, 26,500, and the beginning balance was 23,200 or 300, 23,300, right? 20, 25,300. Okay, so um, you can think about it like so we had revenue of 23,800. Let's just assume that it was all credit sales. Okay, so we would have had an increase. Let me draw this a little better. 25,300, 26,500. So let's assume all of the revenue, 238,000, was sorry, this is totally wrong. These are debits. So 25,300, 26,500. So if all of our sales revenue was accounts receivable, it would have been 438,000. Okay. So what do we need? This is the amount of cash that we collected from our customers. So what is this going to be? How should we calculate it? Is it going to be more or less than this? Yeah, it's going to be less, exactly. Okay, so that's why it's a negative adjustment. That's what I'm trying to illustrate here. Okay, so um, so this $1,200 is kind of it comes from this in that we needed to have this 200 438,000 is how much was showing on the income statement, but really the amount of cash we collected was $1,200 less than that. Okay, whatever, it's 420, whatever it is. Okay, you can do the math, but it's $1,200 less than this. Okay, so again, we're trying to adjust net income, which includes this full $438,000 for how much cash flow came in. And we just saw with the T account that it wasn't a full 438,000 of cash that came in. It was slightly less than that. So that's why this is a negative adjustment. Okay. Um, we do the same thing for inventory. Okay, so we see that we have a decrease in inventory of, I'll just do the math here, 91,900 minus 79,900. So again, this is an decrease in a merchandise inventory. Um, and so that is going to kind of be the opposite of this. They're both current assets. A increase in accounts receivable is a negative adjustment. A decrease in inventory is a positive adjustment. And you can just think about it like this. We have some inventory at the start of the year. We sold all of this cost of goods sold. 209,200 plus an extra 12,000 that we did not kind of replenish. So that's this extra cash flow. Okay. So um, it's like you're liquidating your inventory, right? If we had not changed, if we had no change in merchandise inventory, then um, we basically could have just used cost of goods sold as a like that's like how much cash of inventory kind of left the door. But since we sold an extra amount beyond what we started with, that's kind of extra cash flow. It's cash that we didn't spend to buy more inventory. So that's why it's a positive adjustment. Okay. Okay, and then so now let's do the current liabilities. So we have for accounts payable, 35,600 minus 30,500. I'm getting that from the balance sheet here. So this is an increase in accounts payable. You can think of that increase as like extra money you've borrowed. So this is going to be a positive adjustment too. This is going to be increase in accounts payable. And then accrued liabilities. This is kind of like unearned revenue. You can think about it like that. And this is a decrease. So it's going to be a negative adjustment. Okay. So again, we started with net income and now we've adjusted for all the non-cash kind of, or the non-cash expense here, depreciation expense, and then these changes in our current assets and liabilities representing kind of how much cash was either fronted in the case of like accrued liabilities, or we kind of sold on credit and we haven't collected the cash yet. Okay, so now let's just make sure this all ties together. I'm just going to add up all this stuff. And yes, we got to the right answer. Okay, all right, so now we're doing the investing section. Cash flow, investing cash flow, we'll call it. Okay, so you're going to have acquisition of assets and then disposal of assets. Okay, so once you just continue working, make sure you can kind of figure that out. You're going to have to look at what we did, from the last problem. You look at your plant assets, your land, all this kind of stuff. You see what transactions were non-cash, because remember, this land, there's an increase there, but there is a land transaction that did not involve cash. Okay, so make sure you're factoring that in. You have a change in accumulated depreciation based on uh, your depreciation expense. So you just have to recreate the T accounts for land and plant assets and accumulated depreciation based on the information. And from that recreation of the T accounts, you'll know how much you acquired and how much you disposed of. Okay, so try to do that. Okay, so um, I've just recreated this based on the comparative balance sheet, these three accounts. Now, we have to use some of the information. Okay, so it told us that land purchased 24,500 by financing with 100% long-term notes payable. So we added 24,500 here. So this ties, okay? We don't have to include this in the cash flow section because it was financed with the notes payable. But at least this land account, we can see that there's no other additional land purchases because it is fully accounted by this non-cash investment in land. Okay, so now we can just turn to these two. We were told that there was one disposition. The cost and accumulated depreciation of the disposed asset was $12,060. So I know that there was a credit of $12,060 here and also a debit of 12,060 here. Okay, so now we're going to have to figure out how much was acquired. Because if we just did this minus this, we don't get to this ending balance. Okay, so the math would give us x plus this minus this equals this. Okay, so 123,480 plus 12060 minus 108,840. This gives us 26,700. So now if you do the math, you should be able to do this plus this minus this gives you this. Did everyone get this? Is 26,700? Yeah? Okay. And so basically this is the only thing in investing section. Okay, because we got $0 from that disposition. We just got rid of it. So there is no cash flow coming in from the disposal of assets. We just have really this cash flow of acquisitions. Okay, so we really only have one entry. So disposal, $0 came in, but 26,700 went out in acquisitions. So our total net cash flow from investing activities just equal to this. Okay. Okay. So financing, um, it's going to include dividends. It's going to include any stock that was issued. If there's any new long-term notes payable, that was again. There's one addition to long-term notes payable from that acquisition of land. So that's not going to be in here because again, that was a non-cash investing and financing activity. But maybe there's more. You have to do the math to see if that 24,500 increase in notes payable, if there's any more or anything else that happened in notes payable. So you have to look at that. Okay, so why don't we pause it here and we'll take a quiz. So the issuance of common stock we can just get from looking at our equity section. It told us that there's no treasury stock transactions, so we can just look at the beginning and ending balance. We see that there's an increase, so we can see that we've issued common stock, and we can just figure out the amount by just taking the difference. So this is equal to 88,200 minus 64,300. Okay. Now, notes payable, we have a net decrease. Okay, so we had one transaction that we know increased notes payable by 24,500. We see that we had an overall decrease. So something happened. Okay, so let's look at the T account for notes payable. So we have notes payable. The ending balance, I think, was 77,000. And the starting balance was 103,000. And we know that there is an increase in notes payable by 24,500 from that purchase of land. This is from the land purchase. Okay, so now we have to basically solve for this missing debit, which is the payment of notes payable. Okay, so did someone do that? What was the math? Yeah, Mohammed. 50,500. Okay, so you should be able to do this plus this minus 50,500 is 77,000. Okay, is everyone good with how we use these disparate pieces of information to figure out how much we paid in notes payable? Yeah, makes sense now? Yes? Okay, so this was a decrease in cash. We're paying off 50,500 worth of notes payable. And now the dividends. So we have basically the T account for retained earnings. So this is retained earnings. Okay, so we started off with 6,100. And again, I'm getting this from the balance sheet here. 6,100 here. We ended with 41,800. We had net income of 99,500. Okay, so we have to solve for the missing dividend. So how much was that? I know how much? 63,800. Okay. So now we can go back to this. We know the dividend is also a negative cash flow. And so now when we add all of this up, okay, so now we've finished all three sections. We can get our net change in cash, which is just equal to each of the sections totals. And once I populate this formula is now taking into account the net change. And we can see that it exactly reconciles with our cash ending balance of 26,700. So I just took the starting balance of cash, saw what the change in cash was, and it gives me the exact ending balance that's tied to our balance sheet. Okay? Yeah, Mo. Yeah, they should. Yeah. That's kind of the point of the statement of cash flow is to reconcile to see where all the cash went in and out. Yeah. Yeah, so you'll see this. I think if we go back to our presentation, it was at the bottom, I think, of this one I showed you guys. Where is it? Yeah, so it was kind of down here. So this in this line here, this is like the net, and then this is, if you read down here, cash at the beginning of the period, and then you get to the ending. And if we look here, so let's just prove this. 5488 is the ending balance. So if we look on the balance sheet, we can see 5488. Yeah? Okay. Okay, so let's do one more. Um, this one is presented a little differently, okay? This is a different look. You're just given some facts about the company, okay? So you're not given the financial statements directly. This is actually in some ways easier. They're just giving you the exact piece of information you're going to need to do it, okay? But it's a different like take on compiling it, okay? So really, what you should be able to do is take the financial statements and then compile this set of facts for yourself. And then once you have the set of facts, you can make the statement of cash flow. But they're kind of just giving you the list without the financial statements. So try to piece this together. Um, you will have everything you need here to do the statement of cash flow, all three sections. But you're going to have to do a little like, investigative work to see which part of this information fits where. Okay, so we'll test your understanding of what the three sections are and what information is included in each of them. Okay, so try to do this, and we'll kind of do it together later. Okay, so free cash flow. This is a very used metric in kind of business analysis because investors really, in the end, how much cash the company's bringing in is cutting through a lot of nonsense and a lot of the accounting uh, ambiguities. Okay, so when an investor is looking at and analyzing a business, they'll oftentimes want to just figure out how much cash am I going to have at the end of the day uh, that is generated from this business? Okay, so um, it's kind of, again, cutting through the noise, um, and it's seeing just from the existing business, if I just kept it running, how much cash flow am I going to generate each year? So there's a couple of different ways. There's like no standard way that this is calculated. Um, the most common is you just take the cash flow from operating activities minus capex, and we'll see that capex is also, uh, what that means is, like, some people will say, how much is it just to maintain the current business? Some people will just use from the investing section the total amount of investments made. But that is distorting because if the business is in a growth phase, they're not only investing to maintain the current business, they're trying to grow it, right? So this is why it's ambiguous as to what number is like the right number. There is no right number technically. Okay, so this is kind of the standard. There's free cash flow to the firm, FCFF. Um, this is answering the core question: how much is the cash flow? How much cash does the core business generate, regardless of how it's financed? Okay, so this is an unlevered metric. It does not depend on the other side of the accounting equation, liabilities plus equity, that split. Okay, it's just looking at just from operations. And so what you're doing is you're actually taking this, because again, cash flow from operating activities, the problem with it is that it has interest expense. How much cash interest are you paying? So a company could have the exact same operations, but if it borrowed more money, it's going to have a lower cash flow from operations rather than a company that didn't borrow. So this next one, they're trying to adjust for that financing decision. So it's basically the same cash flow from operating activities minus capex, but now you're taking in the interest expense and adjusting it for how much cash flow that represented, because this little 1 minus tax rate is because interest is tax deductible. You have to do an adjustment to get back to the actual cash flow generated. Okay, so now you have this free cash flow from the firm, which is now adjusted for the financing. Okay, and again, capex is debatable. Is it maintenance capex only, or is it growth plus maintenance? So this is a decision that you as a business analyst will make. What is the cash flow number, or sorry, what is the capex number I should use in my analysis? Now, how do you get just maintenance capex? Because again, the company in the financing section of the statement of cash flow, they may be investing for some huge growth, right? So how do you as an analyst decide how much of that is just to maintain the current business? Well, one way is you can look at depreciation expense. Okay, though it is non-cash, it is using the existing capital base and it's depreciating an expense on that. In the next period, it's going to be different because you've bought all these new assets and your depreciation expense is going to change. But in the current period, you can at least look at the you're basically saying each period the depreciation expense is how much your assets have lost value. So you could assume that, well, I need to at least put that much cash back into the business to maintain it. That's one assumption you could make. Now, that could also be, there's reasons why that may not be accurate, but it could be better than just using the investing section of the statement of cash flow. Because again, if a business is in growth phase, they may be investing a lot more. If a business is kind of like sucks and they're not managing their business well, they may not be investing enough to maintain the business. Okay, they're investing cash flow may be less than the depreciation expense. Okay, so again, these are things that you as a business analyst will have to make a judgment call on. In the textbook, this is an odd thing. It's totally abnormal, but the textbook includes dividends into this. Okay, that is not industry standard. I don't know why they're presenting that, but for your homeworks, just use what the book is asking you to do because that's what will get marked correct. But I'm just telling you that in industry, dividends are not subtracted out because how much you pay in dividends is arbitrary. The management may decide not to pay a dividend at all, right? So that doesn't change how much cash flow the business is generating. So it's nonsensical to include it, but the book does. Okay. Um, and then lastly, the direct method. We have all these adjustments for change in accounts receivable and all that. It makes this operating section of the statement of cash flow very complicated, overly complicated. There's another way to do this. As I said, it's not commonly done. But if you did your statement of cash flow with the direct method, the only section that's different is the operating activities. The rest are the same. Instead of starting with net income, you just look directly at how much cash is coming in and how much cash is being spent. It's much more straightforward to interpret. Okay, so for example, receipts, collection from customers, interest revenue received, and this is again how much actual cash. Okay, dividends received, how much actual cash dividends are received. So you have how much cash was total received, and then you have actual payments, not expenses. These are the actual payments you made. So they have been for some invoice from 3 months ago or from the previous period, but you're just looking at how much cash is actually being spent on all this stuff. So you just have all the cash going out, and then you just figure out how much cash is provided by operating activities. So it's a much more direct, as the name implies, way of understanding cash coming in and out from your operating activities. Why companies don't do this, we can, class is over, but we can look at it in Gemini right now. I told you guys I would look at it, but I didn't. But we can do it right now. But if you need to leave, you can leave. But yeah, that's pretty much it for the chapter. So good luck. Use the videos. I think the practice problem videos